Good afternoon, everybody. So in this lecture, we will focus on management accounting and also the costing system. So when we start management accounting, so what do I mean really by management accounting? Management accounting is concerned about the internal information. This internal information will help the senior management to make decisions. So again, when it's come to management accounting, so that's related to provision of this information required by management for planning, organizing, and control. So the management need this information for planning, organizing, and control, and of course to achieve goals. And these goals, for example, how to achieve, how to increase the sales, how to reduce the cost, how to increase the profit, how to manage the uncertainty, etc., etc. So some question or some examples of management accounting, as you see, what selling price should we charge for a product or service? Have you ever questioned why did you pay 3 or 4 or 5 pound, whatever, when you get a drink from Costa? So again, so this is a management accounting job who does price the product according to, they set up a price based on the cost. Yeah, they calculate the total cost per unit, and then they add a percentage of markup profit, and then they set up a price. So you pay, I pay. How profitable is a product? How profitable is a division, right? So again, that's more breakdown into product and division. When it comes to financial accounting, for instance, so when we calculate the profit or loss for the business, we calculate it based on the whole operation. But here we are more specific in one unit, in one product and one division. How much do we need to sell to break even? Break-even point is the point that the company doesn't make profit, doesn't make a loss. Should we manufacture a product or buy it in? So it's not always the case that the business, if the business manufactures the product or make it, this means, oh, they are gonna make more profit. This is not the case. Yeah, they might find it cheaper if they buy it from other competitors or other suppliers. I'll give you one example. If you look right now at your iPhone right now, you can see the screen. So do you think iPhone, do they manufacture the screen or they buy it from another competitors? So Apple does buy the screen from Samsung, right? Why? Because they calculated the cost and they think, okay, actually, if we buy it in from Samsung, it's cheaper than to manufacture it ourselves. Why? Because they need to buy very, very expensive machine. They need to hire creative people, right? So it's a lot of job, a lot of the. They say, okay, why we should bother? Really, we can buy it cheaper, really. So they can focus on other innovative things. When activity is increased, will there be an increase in cost and revenue? So now we talk about cost behavior. Again, that's a management accounting job. We'll come to it in a bit. So any type of cost or service consists of 3 types of cost. Any type product or service consists of 3 types of cost. Okay, so product such as something physical, something you touch. For example, look here. This is a product. This is product. Yeah. Yeah. Service, something you cannot touch. For example, you went to London and Christmas, and you stayed there 2 nights or 3 nights. You slept at hotel, right? This is a service, isn't it? So any type of product or service consists 3 types of cost: material, labor, and other cost. We call it cost of other expenses. So what do I mean by direct material? Okay, direct material is the material involved, right? If you look at this, you will see, okay, the material is the plastic, isn't it? Some you would say this is wood, right? This is material. You would say, okay, this is a glass. So again, aluminium, material, direct material. The second cost is the labor. The labor which the people, right? Labor, which they spend to make this unit finished. Right. Now, stop. Tell me now. So we know that material, direct material, we know direct labor. And that's exactly, if you look at this unit, you will see, okay, material, labor, people who really made it, it's fine, yeah. But how about the other expenses? How about rent? How about salaries? How about electricity? The business paid them, okay, but how they can absorb these costs into the units? Right, let's have a look. So far we agreed that we have direct material, direct labor, or any direct expenses are classified as direct cost. Are classified as a direct cost. Why? Very simple. Because the cost per unit is what is known. What do I mean by variable cost per unit? Or sorry, what do I mean by cost per unit? I mean, okay, as a manager of the factory, right, I know exactly how much material cost me to produce this unit. I know how much labor cost me to produce this unit. This is what we call it a direct cost, because it's related directly to manufacturing the product or the unit. Right. How about the other cost? The other cost is called manufacturing overhead. Manufacturing overhead is classified as indirect cost. Indirect cost. So when I did say manufacturing overhead, I mean by what? I mean by rent, salaries, electricity, etc. Why it's indirect cost? Because you cannot identify the cost per unit. Okay, why is that? I'll tell you one example. If you went to Tesco and you bought 5 bananas, 5 apples, 5 oranges, and 5 carrots. Look my smile. Right. So how many units? 20, isn't it? And you went to the till and you paid £20 and you left. Fine. If I ask you any question, how much did you pay per unit? How much cost you per unit? How much did cost you per unit? You would tell me, okay, £20 divided by 20 units equal £1 per unit. That's what you're gonna tell me, isn't it? But this is wrong. Why wrong? Because of course you cannot do this, because the price of the apple is different from the price of the bananas, different from the price of the oranges, different from the price of the carrots. And simply you cannot simply do this. The only theory, your theory applies and is right only if you bought all of them are carrots, then yes, you can divide it by 20 units or 20 carrots. That's fine. Again, when it comes to the business, if the factory, they pay factory rent a day, £1,000, right? And during the day, they made the manufacturing different products, and simply you cannot say, okay, £1,000 rent, you divide it by 1,000 units, and £1 per unit, it's a fixed cost, or indirect cost, or manufacturing overhead. You can't do this. Why you can't do this? Because some units takes 20 seconds to produce, some units takes 10 minutes to produce. It's different, yeah, different. And that's why it's called indirect cost. That's why it's called indirect. First, because it's not related directly to produce the unit. It's not directly. And also the cost per unit is unknown. It's difficult to calculate the cost per unit. We have some ways. One of the methods we will cover it is absorption costing. Okay, so this is the difference between direct cost and indirect cost, as I explained exactly. Okay, so direct material plus direct labor is classified as a prime cost. Direct labor and manufacturing overhead are classified as conversion cost. So look at this Ferrari car, the red car outside the School of Management. I was wondering who owns this beautiful car. Maybe this is your car in the future. Right, let's have a look at this car. Right, this car, as I mentioned, any product or service consists of three types of costs. That's material, labor, overhead. Think about this car. If you look at this car, dream of this car, tell me one example of material. Of course, labor is labor, and one example of overhead. So what, of course, you would say one example of material would be the radio installed in the car. Wheels, glass, battery. Yeah, all of these are materials. Can you see? Those materials that become an integral part of the product and that can be conveniently traced directly to it. Can you see? This is what we call a direct cost, material and labor. Again, labor, wages, those labor that can be easily traced to individual units of product. Individual units of product. And of course, we talk about the wages, labor. Okay, remember one thing, right? Wages, labor is different from salaries. Yeah, labor, wages is direct cost because it's related to the product itself. Yeah, and the cost per unit is identified. However, salaries is indirect cost. Salaries is manufacturing overhead, is indirect cost. Why is indirect cost? Because if I am the manager, okay, I'm the manager and I get my salary. So regardless if there's a production or if there is no production, I still get my salary. Yeah. So the 30,000 or 40,000 pound. Okay, this is what we call it indirect cost. Remember this. So, right, that's the difference between the material, labor, overhead, as we explained. Okay, dokie. Now, this is exercise for you guys. So now you tell me right now. Each of these is direct cost or indirect cost. Yeah, let's start with material. Of course, direct cost material, because it's related to the product. Is it traced and conveniently traced to the product? We can identify the cost per unit, isn't it? Supervisor salary, it is what? What do you think? Manufacturing overhead. It's what? Manufacturing overhead means it's indirect cost. Indirect cost, as I mentioned, is different from labor. How about rates for a factory, such as rent? Again, we did talk about it. It's what? It's indirect cost. How about electricity? Again, it's manufacturing overhead. It's what? It's indirect cost. Labor hours, wages, it's what? It's direct cost. Good job. Now we will talk about the cost behavior. Cost behavior means how the cost will react if there is an increase or decrease in the activity, the level of activity. Again, how the cost will react if there is a change in the activity. Activity means production. Let's have a look. We need to look at the three cost behavior here, including variable cost, fixed cost, and stiff fixed cost. Now we need to focus more on variable cost and fixed cost. So variable cost and fixed cost. Right. We did talk about direct material and direct labor. And if you remember, direct material and direct labors are classified as direct cost. As what? As direct cost. So most of direct cost most of direct costs are variable cost. So what does that mean? This means material is direct cost. Yes, material is also what variable cost. Direct material is also variable cost. Right? Direct labor is direct cost, but also direct labor is a variable cost. Right? So when it comes to variable cost, so total production, or not, or say total cost, total variable cost change with the production change. Right? Again, total variable cost change with production change. Right, let's have a look. Give you one example, right? If we look here at the variable cost is one example of the wood, yeah? Wood, £2 per unit, £2 per unit. If we are making 5 units, we are what? The total variable cost would be £10, isn't it? Why £10? Because I guess 5 times 2 equals £10 total variable cost. If we are making 10 units, so the total variable cost would be what? Would be £20. Why? Because 10 times 2. So what you can see here? You can see that total variable cost change with production change, isn't it? Can you see? 10, 20, 5, 10. So total variable cost change with the production change. That's the total variable cost. However, how about the variable cost per unit? Again, how about the variable cost but per unit? Yeah. So what you can see, is it fixed or changeable? Of course it's fixed, £2. Why? Let's have a look. £10 divided by 5 units equal £2 per variable cost per unit. £20 total variable cost divided by 10 units equal £2 variable cost per unit. Can you see? So the variable cost per unit is fixed, constant, right? It doesn't change with the production change. However, the total variable cost change with production change. So we assume when we say £2 per unit is fixed, we assume that the inventory, the material we've already bought the material and it's in the warehouse. Fixed cost. Fixed cost. The cost stays the same when the production change, right? So did you remember when we talk about the manufacturing overhead? Manufacturing overhead, we just say manufacturing overhead is classified as what? As indirect cost. Indirect cost. And most of indirect cost is what? Is fixed cost, right? So examples of manufacturing overhead such as rent, salaries, electricity, yeah? So these are classified as indirect cost. Manufacturing overhead, same as what? As a fixed cost. So rent is a fixed cost, electricity is a fixed cost, salaries is a fixed cost, yeah? So total fixed costs do not change with the production change. Let's have a look. If I show you this example, you would see that the total fixed cost, not the total actually, one example of fixed cost is rent, okay? And the total fixed cost equal £100. If we are producing 5 units, we are still paying £100 a day, isn't it? If we are producing 10 units, we still paying £100 a day. So total fixed cost do not change with the production change. So 100 is 100, and that's true. Yeah, that's right. Look at you. You pay £500 or more or less for your bedroom, and this is a fixed cost for you. Regardless if you sleep there or you don't sleep there, you're still paying £500 a month, isn't it? That's true. Look at, for instance, the insurance. Your car insurance is fixed cost, regardless if you use the car 20 days a month or 15 days a month or 30 days a month, you're still paying the same insurance. Of course, if you have yearly insurance. Look at your phone. If you've got contract, so again, is a fixed regardless if you make calls or not. Internet, the same. So these all fixed costs, guys, for you. So do not change with the production change, irrespective of the activity change. However, if you look at the cost per unit, which is the fixed cost per unit, the fixed cost per unit, is it changeable or constant? Of course, it is changeable. The fixed cost per unit is changeable, right? Look, let's have a look. £100, if you divide it by 5 units, that's equal what? £20 per unit. £100, if you divide it by 10 units, that's equal £10 per unit. Can you see? Yeah. So fixed cost per unit is changeable, and fixed cost per unit, it does what? It does drop with what? With the production goes up. Yeah. So fixed cost per unit reduces when there is more production, and that's right. And this is the term we call it economies of scale. The same. If you want to take a taxi to town, it's £10 for instance, you will pay it in your own £10. If you take 2, that's £5 each. If for a few, £2.50 each. However, the total fixed cost is £10. Yeah, can you see? With there's more increase in activity in production, this means the fixed cost per unit will be less. And as a business, this is the way they try to control the fixed cost and make it a bit lower, so they can make a more profit, or they can price the product less to gain competitive advantage. However, when it comes to variable cost, it's difficult to control it, because variable cost is what is fixed at £2 per unit for the previous example. This is a summary of the variable cost and the fixed cost. Right. Now let's jump to the marginal costing. So what I want you to do for 30 seconds, have a look at this chart and tell me what's going on there. So what you can see here, if you look at the number of units sold, that's 5,000 units sold, 5,000 units sold, okay? And the total cost is 25,000. So we need to sell, as a business, we need to sell 5,000 units in order to cover $25,000 USD. If we sell more than 5,000 units, we start making a profit. So can you see this point at 5,000 units is the break-even point in units. This means this point is the what? The point the company doesn't make a loss, doesn't make a profit. Doesn't make a loss, doesn't make a profit. Right. Okie dokie. The way to calculate the break-even point, there are two formulas, one in units and one in value. But of course, if you calculate the units one, so it's very simple to get the value one. So the formula which you need to focus on and memorize it is the total fixed cost divided by contribution per unit. Total fixed cost divided by contribution per unit. And the contribution per unit equal the selling price per unit minus the variable cost per unit. In value, same, but you multiply by sales divided by contribution. We'll come to it in a bit. Okay, let's practice. Fixed cost £154, variable cost per unit £9, selling price per unit 20, calculate break-even point in units. If we apply the formula, so you can see that £154 divided by 20 minus 9, 11, So this is the 14 units, which is the break-even point in units. So what does that mean? This means that we need to sell 14 units in order to cover the total cost of £280. In order to cover the total cost of £280. So why £280? £280 consists of total variable cost and total fixed cost. So the total fixed cost is what? Is £154. Yes or no? Yes. So £154 is the total fixed cost. So how about the total variable cost? Very simple. So the variable cost per unit equal £9. So £9 you need to multiply it by the 14 units. If you multiply it £9 by 14 units, you should be able to find out that the total variable cost equal £126. So £126, if you add up the £154, so it's a £280 total cost. So the business, to make peace of mind, they need to sell 14 units in order to cover the total cost. After this point, the business will start making profit. Okay, so this exercise is 3 for you. So again, don't look at the answer, try to apply and find out what is the break-even point in units. So again, very simple. If you apply it, which is the 21,000 divided by 3, so is 7,000 units. Okay, margin of safety is used into break-even analysis to indicate the amount of sales that are above the break-even point. So what does that mean really? Okay, margin of safety, in other words, is the difference between the budgeted sales or the actual sales. Again, I'm repeating myself. The difference between the budgeted sales or the actual sales and the break-even point sales. In other words, how many units we sold above the break-even. Okay, let's have a take example. We have, of course, if when you calculate margin of safety, you need to calculate the break-even point in units first. So if you look here, you can see that break-even point equal £70,000. The fixed cost divided by 10 units, which is 50 minus 40. So that's 7,000 units, isn't it? So if you compare 7,000 units with budgeted sales 7,500, so the margin of safety is what? Is 500 units. So this 500 units extra above the break-even point units. This is our gain. 500 units. Okay. And the last topic we will cover today is the target profit. So target profit, very simple, right? So if Tom has an ice cream van and Tom is optimistic, it's in the summer and a sunny day in Swansea, and he's targeting a profit for July, let's say £10,000, right? Let's say, for example, £10,000. That's what Tom is targeting. So target the profit for Tom is what? Is £10,000. That's fair enough. He's very optimistic, isn't it? That's more than me. Right. So now think, for Tom to target £10,000 profit for next month, not next month, I mean in July, summertime, that's what he thinks, his plan, because it's busy, hot weather, there are some events going on. Yeah, he's targeting £10,000 target profit. So the question, how many ice creams, how many units he needs to sell in order to what? In order to achieve this target profit of £10,000. And this formula exactly can help you to do this, which is the fixed cost. So this formula is similar to break-even point in units, just you need to add target profit on the top of this. So fixed cost plus target profit divided by contribution per unit. Fixed cost plus target profit divided by contribution per unit. Let's have a look. Using the following data, calculate the level of sales required to generate a profit of £10,000. So here we go. Have a look. So if you apply the formula, so £50,000 divided by 50,000, sorry, plus 10,000 target profit, then you divide it by contribution per unit, which is 35 minus 20. So that's the answer is 4,000 units. So Tom needs to sell 4,000 ice cream in July in order to make £10,000 profit. Yeah, that's called target profit. So at the end, this exercise for you, this summarizes everything we've done. So what you need to do, you need to calculate the break-even point in units and margin of safety, and at the end you need to calculate the sales are required to achieve this target profit, which is the £50,000. Okay, so spend around 5 minutes. Try please to do the question, attempt this question, and after that you need to look at the answers here and just check if you've got the right answer. If not, just find out what really happened. Okay, dokie. Now some questions. So what do you think of this? I'll give you 30 seconds each. Management accounting is what? So of course is what is management accounting is what is concerned with the provision of information to help managers to make decisions. Of course we are talking about information data, internal data. How about this? Which of the following cost will not vary in relation to production levels? Now I'm talking about fixed cost here, fixed cost. So again, we're talking about what? We're talking about factory rent. Machine power, it does vary, is variable cost. Why? Because if we turn on the machine, there's a cost. If not, there is no cost. How about this? Prime cost. So prime cost including what? Direct labor, direct material, and what? And direct expenses. That's called what? Called prime cost. Okay, here we go. Right, okie dokie. So this is the end of the lecture. So I hope you enjoyed it. So otherwise, so have a lovely day guys. Take care of yourself. Bye bye.